Hey, I'm here with Peter Walker, who's the head of insights at Carta. Peter has been doing such great work for the startup community, giving us all insights on how startup funding works. He loves to tell stories with data, and today we're going to try to tell a few and listen to a few. He's got such a great set of data at Carta because so many of the startups that we work with and so many of the startups in the startup ecosystem use Carta as their cap table management software. So it's a cool place to get insights from. Hey, Peter, thanks for joining us today.
Kyle, thanks so much for having me, man.
We're going to take a look back at 2024 and try to understand what happened. So let's kind of start from a high level view. How did 2024 go? What was it like from a VC funding perspective? Maybe we can talk about the funding activity, how many deals done, dollars raised, and how it compared to previous years at a high level.
I think 2024 was, well, off the bat, a better year than 23.
Which is a pretty low bar.
Yeah, not a high bar at all. That was a recent nadir after the pretty wild frenzy of 21. And then 22 was this transition year where the first half of it kind of felt like 21 and the second half of it felt kind of scary. 23 was a low, and then we peaked back up. To put some numbers on that, it's like companies on Carta, we serve 45,000 US startups today, raised about $75 billion in 2023. They're going to end up raising between like 85 and 90 billion when it's all said and done in 2024. So an increase, certainly, but not, we didn't pop way back up. Even with some major investments going to AI companies, those really didn't take us back over to the edge. So it's a question of gradual improvement here. Yeah. And then you can, split it out by sector, by stage, et cetera, to get a little bit more of a granular view.
Yeah, I'd be interested in hearing a little bit of a stage breakdown.
I think when people talk about the health of a startup ecosystem, the number that they mostly default to is just total cash. How much capital did these startups raise? Which is certainly one way to judge health. I think actually the feeling around venture is much more dictated by the number of rounds, the number of companies actually raising, rather than the total cash raised, because so many of these rounds can be massive for a single company, but they don't really impact the general pool. So if you look at just total deals done, right? So, a startup raises a Series A, that counts as one round. The rounds themselves are probably a little bit below actually where some of the numbers were in 2023. It's down, call it 5 to 8% in early stage. So seed and Series A deals about 5% less than last year or than 2023. Growth stage, so Series B, Series C, a little bit better, 5% more. And then late stage really pops back with close to 20% more deals. So depending on where you were, it kind of felt sluggish or getting a little bit better. And I do think that this AI sort of boom happening within a downturn is very confusing. So some people look at these numbers and they say, that doesn't feel like my experience at all. I had a totally difficult time raising. And then some maybe AI founders are looking at this and being like, it's never been a better time to raise. Now is the moment. So
would you say the data supports some a different reality for a quote AI company versus a non-AI company, whatever that means these days, by the way?
Absolutely. I think it's I don't think, at least in my time at Carta over the last 4 years, I have seen a single sector been treated as differently as AI is being treated now.
Interesting.
Now, to your point, what is AI, right? What is an AI company? Some people get very pedantic about this and they say, look, if you're not building foundation models, you're not an AI company, et cetera. I think revealed preference from the data is that that's not true. If you're a wrapper company, you can still be an AI company. The point is, how are you incorporating AI into some sort of consumer advantage or customer advantage if you're in B2B? And there's just, AI took in, what was it this year? Something like 30 to 33% of all the capital went to AI companies on Carta. That is, by the way, up from like 8% only 2 years ago. So that is a major shift. And I think kind of surprisingly, it's actually a higher percentage of capital the later stage you get, which is odd because most of the time a technological change like this would start at the earliest stages. And then those companies would grow up and they'd get to late stage, et cetera. But here you've seen companies that didn't actually start as AI companies rapidly adopt this and sort of make it their whole company ethos very quickly. And so those major rounds that we read about in TechCrunch, those are dominated. Those are about half of them are to AI companies. So it's in it's in everywhere, and people can talk about it being a bubble. And when they do that, I think it's kind of funny for two reasons. One, there's always a bubble. This is venture. Like this is 8 out of 10 of these companies are going to fail. So yes, there's going to be a lot of waste that is inherent in the whole ecosystem. And secondly,
that's actually the design of the ecosystem.
It is literally the point of this is to take risky bets on companies that are going to fail. So everyone who points to all these VC investments that fail, like I just don't think they understand what venture is. Not to say that there isn't waste that should be not wasted, but in general, you're going to have a lot of waste. And the second point is that AI is like rapidly becoming less of a sector or like biotech and much more of a platform technological shift. So it's not necessarily that these companies are growing up and saying, all I want to do is be an AI company. What they're saying is, if I didn't use AI in some way, shape, or form in my company, I just wouldn't be taking advantage of the latest tech, and that would be dumb.
Yeah. I mean, I kind of just think about it as, in the same way that like software revolutionized both the accounting industry and the industrial industry. It's like it's a tool. I mean, I guess it's actually helpful for our purposes to break it out as a sector to just kind of understand where the money's flowing. But what we're seeing, and I think what I'm reading about is that it's just going to impact every sector in a lot of different ways, and it's going to. I mean, it should be really interesting actually to see how disruptive it's going to be.
Absolutely, I anticipate that within a couple years, I will stop reporting on AI startup funding because every single startup will use AI in certain ways. And then it's just back to like, how do you make money? Are you a SaaS? Are you biotech? Are you hardware?
Totally.
Yeah.
It's like we don't break out software companies, right?
No, we don't.
Yeah.
Exactly.
You made a point earlier that I want to kind of touch back on. It was slightly harder this year for early stage fundraising. So that would be kind of like seed. I don't know. Are we putting pre-seed in this at all, or are we just saying priced seed rounds?
When I'm talking about seed, I'm talking about priced seed, but we do have a lot of data on safes and notes, which make up the sort of the pre-seed pool. That was also, I would say, slightly harder depending on how you define. There's no real good definition of what pre-seed is. The way we typically look at it on Carta is if you raise between, say, 500,000 and 2 million, that's a pre-seed round if it's done on safes. And then if you raise over 2 million, we call that a seed on safes, but that is a completely arbitrary figure. It doesn't, people would say, hey, it has to do with traction, et cetera, but we don't have access to those metrics. So you just kind of have to call it somewhere.
Understood.
But pre-seed was fairly tepid this last year. Like didn't go down, didn't go up, still cash is available to some companies very easily and other companies with a lot of difficulty. And early stage kind of encompasses that plus seed and Series A.
I guess my question is, for early stage fundraising, it seemed like it was slightly harder. Do you have any thoughts on what's driving that?
I think the number one thing that's driving that is changes in investor expectations. I think, talking about comparing, for instance, this current moment to, say, 2021, the underlying metrics that many of these companies are having to show in order to raise cash are 2 to 3 times higher than they were in 2021. So you cannot raise, it used to be in 21, the saying was, if you have $1 million in ARR, you can raise a Series A.
Yeah.
That's not happening today. You need $3 million in ARR, or you need to be growing at crazy rates. It just isn't the case that, like, so many of these underlying traction metrics, the expectations from investors have gotten much higher. And so that leaves some companies out in the cold. It also means that companies that have already raised some capital are, if they raised, say, a seed round in late 21, early 2022 with some sort of expectation about where they need to be to get to that Series A, that was probably wrong. And so they've had to either move much more quickly than they thought, or make that cash last longer than they expected because they needed to get to the next round.
The goalposts were moved on them from, okay, you just need to hit 1 million ARR. And it's like, oh, you need to hit 2 million or 3 million or whatever other metric that is. And
the goalposts always move. Like, it's always a moving target, but I think it's underrated the pace of change. It doesn't usually move this fast. And it really, so that has caught a lot of, call it 2021, 2022 founders in a in a difficult spot.
And is that increasing time between rounds?
Definitely is. There's this chart where we look at the median time between primary financing. So it strips out bridge rounds, it strips out everything except for you raised a Series A, how long did it take you to get to a Series B? Series B to Series C, et cetera. So it's data of round raised.
Yep.
So they weren't actively fundraising through this whole time, obviously. Two things from this chart that are very clear. One, the median time to raise in between these financings is increasing. So if it used to be, hey, you're going to fundraise every 18 to 24 months, that's really, the median is very close to the top of that range and over it in some cases. So if you're a founder and you're thinking, I just need 18 months of runway and then I'm good, like that's probably not enough. The second thing is this chart, what this chart doesn't show is a ton of companies raising bridge rounds, raising convertibles, raising a little bit more capital as they're trying to eke out the right traction metrics to raise that big slug of capital.
Yeah.
I hate to sound like a pessimist on this too much, but I am really down on the prospects of a lot of those companies that are raising bridges. Our data shows that bridge rounds are, if a company raises a bridge round, the likelihood that it will ever raise the next primary round is actually reduced by a lot.
You're less likely to raise that next round if you do a bridge round rather than doing nothing.
Well, see, that's the null case that I don't have.
Yeah.
It's probably the case that those companies had to raise bridges because they were running out of capital. Totally get that.
Yeah.
I'm just saying the graduation rate between the companies that never had to raise a bridge and those that had to raise a bridge is way different.
So the bridge round is a negative signal.
I think that people already think that. I think our data confirms it.
Confirms it, yeah.
And interestingly, not all bridges are the same either. If you raise a priced bridge, that is actually a better signal than a convertible or a safe bridge. Convertible instruments, safes and convertible notes, can actually convert into their caps on the next round at a much lower percentage than price round bridges getting to the next round. Now, why is that? Probably because it's easier to raise a convertible note or a safe in between these finances because it avoids a lot of tricky conversations. So the companies that do that are kind of, they're not taking the medicine they need.
That makes sense to me. Yeah. Whenever you're often basically going to insiders that believe in you to say, hey, can we just get a little bit of cash in the door? We're gonna hit our hit these goals in the next 3 months. So we just need a little cash in the door to get.
And the one nuance there is at seed stage. So if you raise a priced seed round, raising a bridge or a seed extension after a price seed is less of a negative signal than later stages, mostly because those seed extensions kind of, there's a barbell that happens. They're either happening because the company needs cash and isn't doing well, or they're happening because the company is doing so well that the current investors want to preempt the A and want to get back in there for more equity. Mm-hmm. And both of those things are a little bit less on the good side than the bad side, but still both are happening. Once you get beyond that, bridges become, the later you are, the more negative a signal the bridge is.
Speaking of bridge rounds, last year when we had our conversation, we said maybe 2023 was the year of the bridge round. How about 2024?
Tons of bridges, lots of
bridge building.
Lots of bridge building. Will they get to the other side of this river? Or giant ocean? I don't know.
The chasm, cross the chasm.
As a share of the rounds themselves, a little bit less bridging, except for in seed in 24. This is something that has kind of bedeviled me for a little bit here. I kind of expected that the wildness that happened in 21 and early 22 would kind of have worked its way through the system by now. And I just keep being surprised at how much it hasn't. And mostly that is companies making changes, layoffs, reducing software spend, becoming defaults, maybe not profitable, but close enough that they aren't out of the game, but they are stuck. And they haven't closed down. They haven't been sold. They're just kind of stuck. Yeah. And I think a lot of people underestimate how difficult it is to move a company from stuck in venture to unstuck, either with more capital in venture or trying to become profitable and like getting off the venture hamster wheel. That is really hard. It's really hard to do.
Yeah. And there's when you set up from the beginning, when you choose the venture treadmill, it is it's a treadmill that needs to only go. It only has the up arrow on it. It doesn't have the down arrow on. It's like slowing down. The system is designed to go big or go home.
Yep.
And honestly, I think that's a shame because there are a lot of great businesses that get run into the ground trying to do that, and that could be just like really solid, profitable businesses.
Yeah.
But when you choose to take that first check, it's hard to step off that treadmill.
I think there are going to be, and there already are, a growing number of capital sources who agree with you that have different expectations. I would say, and again, this is perhaps a little harsh now, at this point, we're talking on February 10th, 2025. It is the responsibility of the founder to take the right capital for themselves.
Yes.
So I don't, maybe I could give you some leeway in 21 when it felt like everyone was taking venture. Now, you as the founder have to understand your business. And if you take venture capital and you don't grow at venture capital paces, you could kill your company. Yeah. That's obvious. That should be obvious to you by now. I know VCs are very good at selling themselves as this is the right way to do it, but it is incumbent on the founder to understand their own business. And that is not easy, but it is literally their job. So it has to start with the founder of saying, this is the way I want to grow. And this is the right capital for me at this time.
We work with a ton of venture-backed startups, but we always try to encourage and help folks think broader at those very early stages. There are a lot of ways to grow a great business. It's weird that at this point in history, the standard way to do so is to take this venture money that is expecting these crazy rates of growth and maybe get to profitability. Everything else before, like the 90s was let's grow a business to profitability as soon as possible and then grow off our own profitability. That is a really solid way to grow a business. And I feel like it's less prestigious. And that's a frustration to me because I'm just like, man, this business actually deserves, it's going to make great impact on the world and it deserves its shot. And it's not a venture business, but it's going to do awesome. And so let's not, there's an honest conversation that founders need to have with themselves about saying, I'm okay with lower prestige if that's a thing to create higher impact.
Yeah, we underestimate how good venture is at talking about itself.
Yeah.
And if there's one thing venture is amazing at, it is making venture capital look cool and the default path. And it just shouldn't be. And to be clear, it never has been. The vast majority of companies will never take venture capital and should.
In the history of man, it never has been.
And even in 2021,
even today,
the peak hype boom, venture is a small pathway for a small minority of companies. It just isn't. It just talks about itself as though it is the only thing that innovation comes from. And it's not, but it does tend to have bigger successes, which then drive attention, which then drive this whole ecosystem. And there are tons of venture investors that didn't exist 3 years ago and the whole thing. But just another admonition to the founder, this is your job. You have to get it right on the capital sources. And if you are on the fence about taking venture capital, don't do it because it will demand things of you that could kill your business. It is very true.
Founders, listen to Peter.
I work at a company that exists for venture-backed businesses in the main, We help tons of other kinds of businesses, but venture is our core sector. And I'm telling you, it's not for everybody.
Do you have any data about down rounds or companies shutting down?
This is no one's idea of fun times,
I guess it's really piggybacking on what we were just talking about, which is maybe folks going the wrong route. Maybe they shouldn't have gone the venture route.
Exactly. And to the earlier conversation of the echoes of 2021 coming back to bite us, that is showing up in the data pretty substantially. So in terms of down rounds, call it 20% or so of all the rounds on Carta this year were down rounds. That is substantially higher than it usually is. Usually it's 10% or so. So why are they doing that? Because they don't have other options, because they were overvalued in the prior couple of years and they need to revalue themselves in order to be realistic in line with the rest of the market. So this is just an expression of valuations in prior years getting out of whack.
Well, this is I feel like the best chart to show the 2021 hangover.
Right. You're basically just saying the companies that would have taken different valuations in 21. We're seeing them now.
Yep.
And that's tough. And then shutdowns are always a tricky stat to report on. But so two things are true at once. One, there were more companies that shut down on Carta in 24 than we've ever seen before. Highest every year for shutdowns.
Is that just by volume? Because you probably have more companies now than you ever have before too.
Exactly. So it is just by volume.
Gotcha.
So then as you sort of intimated there, the natural next question is, okay, but is the failure rate higher, right? Or higher percentage of companies failing? And the answer to that is really tricky to tell. We don't think it's that much higher. What we think is it's more concentrated. So it happened more quickly. But net, seed stage companies, if you raise the seed round, what percentage of those companies ever IPO or get bought? It's still less than 10%. So those percentages are fluctuating, but they're in the same range. What's happening now is that tons of companies were funded in 21 and 22 that don't make sense now. And so those companies are shutting down. It's not easy. Like, it's super tough on founders and employees for a shutdown, but it also isn't surprising. This is kind of what you would expect. If interest rates change, funding declines, you're going to have a lot of companies caught in the middle.
Let's switch gears a little bit and talk about founding teams. So I'd love to hear if there's any interesting trends in founding teams in 2024.
There's so much cool stuff on founding teams from us. Actually, we just went through an exercise where we looked at, it was probably 40,000 founding teams and how they split. The general gist of it is that it used to be that founders would split equity unequally to start a company in most cases. So if you have two founders, the equal split is 50-50, unequal split is anything else. I think what's interesting is that has gotten less and less common. So it is still the case that many companies will split unequally, but it is also becoming more common for companies to split equally at the very beginning. So that's mostly, I think, this is a guess on my part, because of, there's a bunch of people in the startup ecosystem here in Silicon Valley who have kind of pushed equal splits as the right way to go about it. YC in particular, are very, very big on equal splits.
They're very vocal about that.
They super are. And I get why. Like, it makes sense, So this, for instance, it shows you the percentage of companies by the number of founders in them that split equally by year. So that's the year that they were incorporated. So those two founder teams, you can see just slowly, gradually, a higher and higher percentage of them are saying, look, it's two of us. We're going to start 50-50 and go from there. Right. I think that's an amazing way to build a business. It is not necessarily, quote unquote, more fair. An unequal split can be totally fair if it comes with unequal responsibilities. And I will note that once you get to later stages, so once you get to Series C, D, E, or IPO, the percentage of founding teams that are still equal is much, much lower. And that, founders leave, you have different funding requirements, somebody else becomes the CEO. There's just a lot of stuff that happens along the way.
Anything about size of team?
So there's two kind of contrast. This is actually probably useful for founders who are considering whether or not to take venture capital. How many founders are in your team? And you can see one clear pattern, which is, depending on the years, again, incorporation year, solo founders, teams with one founder, have become more common over time. That's a very clear trend. However, what that doesn't show you is that the actual percentage of those companies that get funded by VCs hasn't really budged. So VCs prefer to have co-founders. I think that's a really clear finding in the data, is that if you are trying to take venture capital, you are probably more likely to successfully fundraise if you have a co-founder. And why do VCs want a co-founder? I mean, insurance in case somebody leaves, complementary skill sets. So it's very often that there's like a business founder and a technical founder, et cetera. So, if VCs invest in a company with one founder, they're putting all their eggs in a single bucket and kind of increasing the risk on an already risky investment.
And that person needs to be essentially a Superman. They need to be able to, whatever, code and sell really well, and they need to be able to do all the admin and hire well, and
Totally.
that's just like unlikely to be in one person.
If you are trying to locate all of those skills in a single person, it's likely that she or he will. It's tough. It's super tough to make it all the way through this. And in the event that somebody leaves, if there's 2 founders or 3 founders, like another founder who still has that founder privilege, which is very important, can take over and make decisions that people will follow, as opposed to like bringing in a professional CEO at Series A or B, like generally doesn't make sense. It just doesn't. Like the company will die without the founder's like motivation.
So let's talk about safes. Safes have become the dominant form of, we'll call it pre-seed funding. Are there any interesting trends in safe, or I guess we can say convertibles too?
Yes, sir. I mean, this is a picture of dominance here. The black line is safes. The blue line is convertible notes. Like, people just like safes better. Why do they like safes? Because convertible notes come with an interest rate, and who wants to pay an interest rate on an early stage startup?
An interest rate that will likely never get paid.
Like literally 99.9% of the time will not get paid. Yep. Yes, the interest rate is a figment, but still, it's there. What it does do, and why I think this is something that I would probably, if I thought this was going to continue this way, just stop reporting on it. But I do sense in the ecosystem some backlash coming for safes. And the reason being is that they are kind of being used in ways that they were not initially anticipated to have been used. So the safe was invented to take the first round of capital where a valuation was incredibly difficult to assign. And the founder and the funder were in agreement that what's needed right now is a little bit of cash, and then we will deal with questions of valuation and ownership in the future. Now people are raising 2, 3, even 4 rounds on safes. Most of those are post-money safes, so they don't dilute each other. There's like cap table mechanics that get screwed up. There's expectations that get screwed up. We are overusing safes. And we're even, as we talked about a little bit before, we're using them in between priced rounds in ways we haven't ever really until the last couple of years. And I don't think that will end up very well either. So I love safes as a way to get started, but too many founders stay on them for too long.
It's interesting. I think one of the things that we've been seeing is when you stack safe on safe on safe, it's the beauty of the safe is also its dark side, which is it's too easy. It's like too easy to just issue these things and 100%. Get capital in the door. And it's unfortunate when those things convert and founders look at the cap table and are just like, oh my gosh, wow, I have how much of the company now?
I couldn't agree more. Well, one, again, founder responsibility here to know your cap table to understand how dilution works. But 2, it is too easy. And the main reason it's too easy is because they're rolling. They just roll. You can sign 1 check today and 1 safe tomorrow, and you just can do all these little deals. But they do matter. Equity rate or selling equity on a safe is not free. You are selling equity for capital. It just doesn't feel that way because you don't give them the equity up front. And that's it. It can be very tricky.
So safes are dominant. Is there any other? And I'm assuming that post money is dominant within the safe. Within the safes, it's become the more dominant form.
85, 86% of all the safes that we have are post money safes. That is for 2 reasons. One, it's more investor friendly. And so it becomes the default that many investors use. And then 2, YC took the pre-money off of their website.
Yes.
So it becomes harder to find those templates, and people go through the path of most convenience.
They also took the capped and discounted off their website too, which is an interesting move.
They certainly did. Very interesting. And they don't talk about their own safe deal, which is for a very low cap. For a lot of founders, but they're YC, so they get to do it, and they deserve it. I mean, their brand is amazing.
This is still a little bit of a tough environment, especially for earlier stage fundraising. Did the terms in 2024 get more investor friendly at all, or stay the same, or what did you see there?
Honestly, the terms of these deals, I think that this is in some ways an expression of how professionalized venture is getting. That for early stage, so seed and Series A deals, even in the difficult parts of 23 and early of 24, the deal terms never really changed that much. There are some investors who are more predatory or like are taking advantage of founders, et cetera. But in large part, like things that favor the investor. So liquidation multiples over 1x, participating preferred stock, cumulative dividends, these things that are giving the investor effectively more leverage, better deals. They just don't really show up in early stage. They're less than 5% of deals every year that we've measured it. So that's
even on hard times.
Even in hard times, which I really like. I mean, I think that's good for the ecosystem as a whole to be like, look, this is what a clean contract looks like. Let's just move forward.
Yeah.
Now, that is not the case for late stage deals where, we're talking pre-IPO companies, like something like 15 to 18% of those deals have some sort of investor favorable preference to them. And that, those are really big companies at that point. Investors can, I guess, hopefully reasonably expect an IPO in the next 10 years or 5 years, whatever. So I think that those things make more sense in those stages.
There's more of a known at later stage than there is at the earlier stages.
Exactly. There's really no, a high liquidation preference protects the investor in the event of not a good exit, which if you're raising seed capital, that's not what you should be shooting for.
Yeah. Let's talk about geography. Anything interesting? Any geographic trends for fundraising around the U.S.?
Yeah, there's a bunch of different things we could look at in terms of geo trends. On an overall basis, the way that I like to paint this picture is anything that you've heard about the Bay Area losing share is completely wrong. Bay has never been stronger. In the Bay Area, we combine San Francisco and San Jose, like metro areas.
Sure.
It's 35% of early stage capital. It's 50% of late stage capital. It's the place for startups.
Sure.
However, while that's also happening, there are more cities around the US that actually support venture ecosystems than there ever have been. So the Bay is strong, but the rise of the rest is also true at the same time, which is a bit confusing. So for the rest of it, we have obviously New York as our second ecosystem. I would call those they are by far the most developed ecosystems. They have broad-based networks. You can fundraise for all different types of startups there, et cetera. And then Boston and Los Angeles. Boston used to be just for biotech and is now really growing into other places, which is really cool to see. And then LA is very diversified, especially now with some hardware and defense tech there that didn't used to be. So those are the big four, and then lots of cities down the list.
There's when you join a startup, you get issued stock options. That's the bet is you get to work at an innovative place. You get to build something awesome. From a financial perspective, you're probably taking less comp than you're otherwise worth in the market. And getting some of that in equity. And I guess the question is is that last part of the dream coming true for startup employees? Are they able to are they exercising, and is that meaningful for them?
No, it's not.
No. Okay.
And I hate to say that so baldly, but I guess an admonition for any people who are considering joining startups, and by startups, I mean really early places, pre-seed, seed, Series A. Join with the expectation that your equity will be worth $0 ever, because in most cases it will be. Join because you think you can learn more at this startup than anywhere else. You can get involved in things you wouldn't be able to at a bigger company. You are obsessive about the problem that they're solving already, so you would be kind of thinking about this anyways. Maybe a great way to think about it is, if you were ever going to be a founder, would you found a company like this company that you're joining? Well, then you should maybe join it, right? Because you're already getting the chance to work on that problem. But financially, it's a bad bet, or it has been over the last 5 years. I think that when it works well. And we at Carta are obviously not against equity. We think it's an incredibly important part of the ecosystem.
Well, it's a big part of your mission, right?
Create more owners has been the mission of Carta for many years. So we love equity, and we think it is actually instrumental in building wealth across this innovation ecosystem. And it's amazing when it works. But the vast majority of the time, just look at it from an investor perspective. If 9 out of 10 startups don't work, then 9 out of 10 equity packages are not going to be worth very much.
Totally.
That's just the facts. So equity is something that you should negotiate on. It's something that you should treat as upside potential, but it is not something that you should bank on being real unless you're joining this is not true if you're joining a really late stage. So if you join SpaceX today, or if you join Stripe today, then your equity package is worth something for sure, no doubt. But that doesn't apply to most early stage companies.
Speaking of Stripe, what's the IPO story in 2024?
Probably not going to include them.
Nope.
There have been a huge dearth of IPOs. I think we're all kind of familiar with that, right? It's been super quiet on the IPO market for a long time.
Yep.
This chart has it. So they narrowed it down to US tech IPOs, so it might not include some biotech stuff, et cetera, but still you're looking at 14 over the last 3 years. That is, it's never been that low.
Insane.
That's wild.
Yeah.
So, and no matter how many companies get acquired or how many secondary transactions there happen to be, they cannot take the place of a healthy IPO market in terms of recycling capital back into the ecosystem. We have to have IPOs in order for venture to work. So if you are involved in startups at all, you want 2025 to be a much higher number. Will it be a higher number? My instinct is yes. It's definitely going to eclipse 6 unless something goes terribly wrong.
Yeah. Okay.
But I don't think it's not going to get to 140 like 2021 did. We're probably looking at 20, maybe 25.
Yeah.
And the likelihood of that 25, including really gigantic names that everyone is familiar with, is also, I think, a little bit over optimistic. My instinct is that places like Stripe, again, I've heard some arguments counter this, but in general, my belief is IPO for a company like Stripe doesn't make sense, because why would they add regulatory burden to a company that has effectively unlimited access to capital in the private markets?
Mm-hmm.
They don't need it. And their employees don't need the liquidity because they can run secondary tender offers for those employees whenever they want to. And the demand is very high. So I've heard the other argument is it is useful politically, not in terms of like vis-a-vis the administration, but it is useful to be a public company so that you have backing from retail investors and retail funds and all this kinds of stuff. And there are some ways in which I think that's true. But in general, if you're sitting there and you're John or Patrick at Stripe, there's not a huge carrot.
Yeah, I get that.
And that only applies to 5 companies, right? There's not that many companies that are in that privileged a position, but
it's a very nice position to be in. Speaking of the administration, does the change in administration have any impact in 2025 for the startup community?
Already the discussions have whipped up, right? You saw carried interest as a potential political football here in the next admin or next legislative session. There's ideas about how the FTC is going to deal with M&A. There's all sorts of things that could have quote unquote good or bad impacts to startups. Yeah. Changes to the accredited investor definition, like all of those things are kind of on the table. I think anyone who tells you that they know exactly where this is going to end up is totally wrong. Like we're in a period of high period of change. I do think that one maybe slight prediction is that I do think that there will be more acquisitions this year, and that some of them will be at scale in a way that we haven't seen in a little while. But again, that's mostly a guess.
Yeah. Any other predictions for 2025?
Look, I think 25 is it's not a make or break year. How do I put this? There is a ton of optimism around startups like having this massive rebound in 25. I think I'm more pessimistic than that. I think this will be just another year of gradual progress up from 23. And the bifurcation of startups, of like people that you read about where they raise as much money as they want to as easily as they can, and they're in this AI golden cohort, and then everybody else, I think that gap will only get bigger. So it's kind of a tale of.
But you're saying the gap between quote AI companies and non-AI companies in funding will get bigger.
But even within AI companies, I think that there is a cohort of AI companies that have kind of been skating by on promise, and then 25 will be a real year of like putting money. I mean, there are credible investors who are saying that really rapid ARR growth isn't the signal that it used to be. And that seems so silly. It's like that should be the whole thing, right?
Yeah.
But we're like, look, we don't know if these AI budgets are going to stay experimental or how much of that is going to convert to long-term users. Like retention is a gigantic portion of this math equation, and it hasn't been focused on as much as ARR growth. So there's weirdness happening. Even AI is no longer a stamp of you get to have as much cash as you want.
Yeah, and then I would imagine the flip side of that coin is that almost every company that's being created right now has some AI in the stack.
Exactly.
The
other metric that is definitely in vogue, which is for sure true, is ARR per employee, right? So a lot of these companies are trying to stay smaller longer in terms of headcount and be more capital efficient. I think that's probably very healthy for the ecosystem as a whole. It's kind of sad for I'm one who benefited greatly from working at early stage startups in the beginning of my career. I hope that's still available to many people, but definitely is the case that these companies are moving faster with smaller teams.
Is it possible now for us to say, with kind of historical hindsight, to say that 2021, when we'll call it first half of 22, was just a crazy outlier, and that would it be fair to say that we're kind of back to 2020-ish levels, kind of pre-pandemic levels of funding volume and like startup ecosystem valuations, et cetera? Are we just calling the pandemic a blip and saying that we're back to basically where we were before the pandemic?
I think the first half of that is totally true, which is 2021 was a historical outlier that will very likely not be equaled for many, many years. But it isn't a blip, because that implies that we're kind of over it, and we're not over it. The changes that it wrought, we are still dealing with the hangover from 21. Yeah. It isn't like something that is far in the past. It is alive in the cap tables and funding histories and challenges of a lot of these companies are dealing with the fact. Now, I do wonder if when we talk next year, if we'll still be talking about 2021. Agreed. Yeah, maybe this is the last year that it's like majorly impacting things. I do think, though, it's not necessarily the case that I would say we're back to like the health of 2019 or 2020. I think that the one thing we tend to not talk about enough is just interest rates. Interest rates have gigantic impacts on startups. We have not for the last 10 years been in an interest rate environment like we are today. That has deep impacts that people just don't talk about enough.
Peter, before we drop, I would love, can you kind of share with the audience kind of what you're up to at Carta? Maybe talk about your newsletter and talk about your podcast a little bit, what you're doing there.
I run the insights team at Carta, which is built to tell stories with data and build a lot of interesting narratives and useful data artifacts for founders, employees, investors across venture. We have a newsletter called the Data Minute. If you just hit Carta Data Minute in your Google, you can find it and subscribe. It's one chart per week, something that's interesting to us about startups. I also do a podcast of the same name, the Data Minute Podcast, where we bring on amazing, cool people across venture and talk about what's happening in startups that day from the investor side, et cetera. And I think that one plug for new stuff this year is we've kind of spent a lot of time building up this wonderful practice within company data and giving it back to founders. We're starting to do the exact same thing for venture investors with the big amount of data we have from venture funds that use Carta. So this year will be a ton of interesting stuff. So if you're an emerging manager or someone that's a venture investor, like we're going to have a lot more to say to you this year too.
Hey, thanks for taking time with us. And this is so helpful to move from kind of anecdotal, like this is how the environment feels, to data of like, this is actually what's happening.
Yeah.
And it just is such an important thing to be rooted in reality as you're trying to build an awesome company. So this is a huge service to the community. Appreciate your time.